All right, everybody, welcome to episode 2 of season 1 of Selling the Stateline, the vlog. Yes, the video vlog that I'm bringing to you guys every week or two. Today, for episode 2, it's Interview with a Loan Originator, my little play on words. And I'm sitting with my good friend, Bruce Biggers. He is the branch manager at Planet Home Lending.
Hi, guys.
Here in Rockford, Illinois. And we're going to discuss some great things today, like interest rates and what they mean, where they're at, where they're going, what makes that stuff happen, and also about the whole process of getting approved for a loan. And the great thing about this here, I know people watching this on YouTube, it's a few days after we're recording, obviously, but we just had your ribbon cutting here for your new office.
Yes, we did. Yes, we did.
So Bruce, why don't you talk to everybody, tell them who you are, what you've been doing, and tell us a little bit about you and Planet Home Lending.
Sure, no problem. My name is Bruce Biggers. I am the branch manager here at this facility and a couple others here for Planet Home Lending. What we do is we do home loans for purchase, refinance, debt consolidation, focusing on 1 to 4 family units. So that is what we do. I've been in this industry for 28 years now doing home loans.
So you're kind of an expert then, you know what you're doing.
Yeah, know what I'm doing. I've, been through 4 different of these kind of rate environments where things are going up and changing. So I've seen the cycle, I know what's going to happen, seen it before.
Well, I will say, and we'll dip into where we are right now, but same as you, I've been a homeowner since the late 90s, and I've had multiple homes I've purchased or refinanced since then. And I will tell you, the rates we had just recently are amazing, but it was almost 17 years ago when I bought my house in Roscoe, and I was ecstatic to get an 8.5% interest rate.
Oh, sure.
On a primary residence. And I had a 9 3/4 on rental property just a couple years later. So that was in like 2007, before everything went crazy in the home lending world.
Sure. When I bought my first home in 97, I believe, my interest rate was 8.5.
Oh.
So, the 5s that we're in right now seem, just because of recent history, to be high, but really in the grand scheme and in history, this is still a pretty darn low interest rate environment.
I know people that bought in the 80s and they were in the double
Teens.
digits. Yeah.
18, 19,
20%.
touched 20% back then. Yes.
Right. So where are interest rates right now? Like, I don't expect you to know them right to this minute. Of course, like I said, we don't know when people are watching, but where are they at around right now? Middle of April, towards the end of April, 2020.
Sure. Right now, you're in the mid 5s. That's where you're at. Now, this is going to fluctuate daily, of course. Sometimes it fluctuates 4 times a day. Depends on what's going on. But the rate environment is definitely increasing. You do have some better days, but most days it's up 2, 3, 4 days in a row. Then you'll have a down day. Then you'll have another up 2, 3 days. And when I'm talking upper interest rates, it doesn't mean that the interest rate itself goes up 1/8, which is the increments that the interest rates in my world go by for the most part. It's the cost of money. What people don't understand is if you want a 3.5% interest rate, you can get a 3.5% interest rate today. You're going to pay a crazy amount of money, an amount of money that doesn't equate to being smart.
Is that what they mean by points?
Discount points is what it's called.
Okay.
So just an approximation on a $200,000 loan, you'd probably pay about $30,000 to get that rate. So when you do the math, that makes no sense. So nobody does
that. Go towards the principal of the home, or is that
no?
That's
just a fee to give you that rate.
Oh.
So what most people do is pick what's called a par rate, meaning it's an interest rate where you don't have to pay any money to get it. The lender doesn't owe you any money to take it, because I could actually give you a higher rate. If you came in today and you had excellent credit, I could give you a 6.1 interest rate, and I would give you $3,000, $4,000 on top of it. But usually when you do the math, that's not smart. Most of the time you want to pay a small discount or a par rate, and that makes more sense, especially when you look at the history of a loan. And most mortgages only survive around 5 years before they're refinanced, you move, or pay it off. So you have to take that into account when you're figuring how long it takes for the cost of money and what you pay for.
Right, because the average homeowner in America, I'm saying on average, sells their house and moves every 5 to 7 years. That's usually when a family has a lifestyle change and they're looking to either upsize or downsize, or they get sent to a new place. I've had a lot of that recently where we have people coming from out of state to where we are, people from where we are moving to other places out of state just
Correct.
for jobs with the current environment and the current worker shortage that's
Sure.
going on. Talented people are getting recruited all over the place. So how important is it to work with someone locally in the market rather than going with like a big national conglomerate? Like, I know, don't get me wrong, Planet Home Lending is a national company, just like my company's a national company, but you also have the people that are local to the area. How important is that in the mortgage business?
I would say it is one of the most important things you could do. One of the things that you're seeing out there in the mortgage space right now are the big, huge mortgage companies that are just nothing more than a URL, their website, the Rocket Mortgages and the like, for instance. The problem is they're not local. And not being local has its disadvantages most of the time, because each individual county, not just state, has drastically different rules, drastically different fee sets, different information, that if me as the loan originator isn't aware of those rules, we can make big mistakes, cause issues that could actually kill financing if we don't know what we're doing. So being local does matter. Now, since we're a national company, we can refer to any one of the national branches that I have here at Planet, which I do quite frequently. Somebody comes to me and says, hey, I'm moving to this state or that state. We would refer to another Planet person. However, we do also loans in other states out of this branch. I'm licensed in 3 states. Marcia, one of my biggest loan officers, is licensed in 6. But we know those areas. We took the time to research and learn the areas and actually go down to these different states quite frequently to meet people. So I think that is crucial, because it is so easy to make a mistake as an originator, not knowing the rules or the laws and how to put that together, that you can actually lose your contract and lose your deal.
Well, one of those rules as well, like we were working not too long ago with a client that was FHA approved, but wanted to buy in a condo. And I didn't realize that in certain counties, there's not many FHA approved condo associations.
Correct.
In Illinois. As we go towards the Chicago suburbs, they all seem to be, or at least the majority of them. But in, like, say, Winnebago County or Boone County, there's very few.
Correct.
And while we're talking about that, people listening to like FHA, what's FHA? Explain the different types of loans that somebody could possibly get, like in a nutshell. I'm not asking you to go into major depth, but
Sure. The best way to explain who's HUD FHA, who's VA, who's Fannie Mae, Freddie Mac, if you've heard those terms, conventional financing. Those aggregators, if you will, are really insurance companies. They're insuring the loan, and they have their set of rules that you need to follow in order to get it done. And they all have the different purpose for what they're good for. And, people tend to say, oh, well, for instance, FHA, those are for people for first-time homebuyers only. Absolutely not true. Or perhaps they're for folks with bruised or damaged credit. Now, they can help with bruised and damaged credit, but there's many times that I have my A+ credit client with tons of cash and abilities go FHA, because the rules and the guidelines are different and tend to be a little more aggressive. And right now, interest rate on an FHA loan is lower than a conventional loan. You can get high 4s on an FHA loan right now with us. So it just makes more sense sometimes to go that direction, even though everyone views conventional as a better product, and really it's completely situational. And sometimes it matters on the house. I say the house is going to dictate what type of loan you do. So we pre-qualify our clients for all the different loans they qualify for, knowing that house is going to say what we're doing.
And one example of an FHA, which is, the Federal Housing Authority loan, they have a second inspection process during the appraisal. So some houses, if they're older and have a lot of deferred maintenance, they were built before 1978 in particular, if there's peeling paint, exposed wood in certain cases that have peeling paint, or some other items that they don't find, handrails or non-conforming stairs.
Sure.
Sometimes those will be red flags, which will cost the home seller some extra money by taking that loan. So I understand why conventional seems to be the way to go. But
But let me tell you something that's different that most don't realize. 15 years ago, FHA had a very large 4-page inspection list that appraiser had to go through so many things. I would say if the level of house repair needs to be this on a conventional loan, FHA is just slightly worse. Not a lot.
okay.
A lot of people don't realize that FHA inspection, that conventional loan's doing very similar things. So yes, there is a little more inspection wise that has to happen at FHA, but the difference is very minute. However, most people think it's huge.
Right.
So, and there's even times where FHA will approve a house on appraisal or conventional won't because there's an odd rule there.
And I've seen that happen where there was conventional repairs. There was a conventional mortgage recently for one of my clients that they had a list of repairs they wanted done for the conventional mortgage, which I thought would only be stuff that would red flag on an FHA, but this was required because of the age of the home and other items. So they wanted a couple of handrails built
Yes.
before they would allow the mortgage to go through. So the house would be insured. So they were making sure that everything was covered. So yeah, it's an interesting series that we could talk about different loans all day long.
Oh yeah.
But talk to me a little bit too, because this is one that I'm seeing a lot of this, and I just got through a certification class to be an American Warrior real estate agent, which means that we specialize in working with our veterans and our military families. And I know you have similar items within your company, but also within the practice of being a mortgage originator, and a VA loan is one of those great things. But some sellers are not wanting to look at VA loans, and I don't understand why. What is different about a VA loan over other types of loans?
Well, VA, in my opinion, most of the time for the veteran is the best loan you can do. It is an incredible loan with no mortgage insurance and a great rate, many times beating conventional, that has no down payment. It is really my favorite loan to do.
So what would be the risk to a home seller then to?
Well, just like FHA, there is an inspection they do. And it's very similar, almost the exact same, really. But I think it's the misinformation out there that a seller assumes that there's this huge, drastic process. And really all any appraiser is looking at are health and safety items. For the most part, that's the big thing. So, conventional, FHA or VA, no health or safety items. And you would think as a seller, you would want that because it protects the seller as well if there's no health and safety items. So, I think it's also a shame that many sellers say, oh, VA, we don't want to deal with it. Really? I've got a veteran who served their country doing the best loan you could possibly do for a buyer most of the time. We should cherish that veteran and say, you know what? Yes, we'll accept your offer. But you're right. I do see many times where they see that VA loan and it freaks out the seller. In reality, it really shouldn't.
Right.
It really should not.
So moving this along, we've gone through some of the loans, we've gone through some of the interest rates. The biggest thing, the steps. I've heard a lot of people say also, I'm never going to be able to buy a house. I don't have enough money to put down. I probably won't even get approved to get a loan. And it deters them from getting out there and actually trying to look. So what do you say to somebody like that? What's the first step to take?
Well, number one, burying your head in the sand won't help. If you believe you have issues buying a home and you're not quite sure what they are, but you've had credit issues in the past, they don't disappear. They don't go away. So you're best off knowing what you're up against. We have a phrase here that we tell our clients. We're either going to tell you yes, buy a house, or we're going to tell you later. And we're going to help you through that process of being able to buy a house and give you some guidelines, some guidance what to do. Sometimes it's an income situation, but most of the time it is a credit situation. I also tell folks, kind of think of credit as a game. There's many facets of how a credit score works, for instance, that really don't have a lot to do with how you pay your bills. It's the credit mix. I hear a lot, I don't want a credit card. They're evil. I understand that. But you need a credit card. It really helps your score. It is part of the score. And without one, you're missing a large chunk of possible score. And that doesn't mean go out and get a bunch of debt. That means open a card and don't use it sometimes, or use it very infrequently. That is actually a better prescription.
So instead of using my debit card to just pay for my gas every time I fill up and pay it there, go use my new credit card, pay for my gas, probably get a cashback reward on that,
Right.
and then pay it off at the end of the month, just like I would have coming out of my checking account on my debit card.
Which is exactly what I do. I have a credit card that has cash back, and there's different bonuses depending on what's going on, percentages. And I buy everything humanly possible with that card. But I'm the type of person that I don't like to see a big bill. I guess it's just something in my head. So I literally pay it probably 4 or 5 times a month through the mobile app. So I just pay it as I go. I just keep paying it.
Which you can do that with a lot of these cards now too.
Which means you pay no interest. If you pay off that balance before the due date, you pay 0 interest. So I have a credit card that makes me a lot of money. And over time, thousands and thousands of dollars of their money, and I've paid 0 interest on it.
Plus you're building your credit score, which is helping you when you're ready to get a loan.
Correct?
So
Correct.
I've had, because I'm in the business, people come to me and they go, I want to see a house today. And the first question we ask is, have you been pre-approved? Is it pre-approved or pre-qualified? What's the better way of determining this?
Pre-qualified is a loose definition that really can mean as little as I've talked to a client.
Okay.
I don't even have to pull the credit necessarily for pre-qualification. A pre-approval means the information's been vetted. I have, and my company has looked at their income documents, looked at their credit documents, looked at, even ran an automated approval through an automated system to get them approved, which is about 95% of home loans, it seems these days, run through that automated system with an approval. So it's more solid. It's not just we think we qualify for this. It's no, we know we're qualified for this. So you really want a pre-approval in today's hot market, because a pre-qualification is pretty weak. You do want that full pre-approval.
So with the pre-approval, how many steps will you go to? Like I've heard of some companies will do all the way up to, we just basically need a home number and an appraisal for that home and everything else is ready to go. Like, is that very common in this market right now, or is that?
I would say it's not that common. Now you can go that far, but the reality is it depends on the loan officer. That loan officer knows what they're doing. I mean, come on, guys. I've been doing this for 28 years. I know what an underwriter is going to say. There's even times, I hope my underwriters aren't listening, that I correct them and tell them the guidelines. Rare, but it happens. So going that extra step is usually not necessary, especially when you have an automated approval.
Okay.
What happens is the underwriter isn't really underwriting the credit worthiness, so they're really not underwriting the amount of money the person has. They're data checking the documentation. They're not saying, at least with my company, other companies, this differs. You'd have to ask who you're going with. Hey, I don't like this credit. I have an automated approval. Doesn't matter if I like it or not. It's approved. That is the true guideline we follow.
So the underwriter,
which we all run, and I run immediately when I get the information.
So the underwriter is more like a fact checker, like on social media,
Correct.
except they're actually correct.
Sometimes.
Sometimes.
No, almost always.
No, but,
we have fabulous underwriters, so I can't say it.
But that's the thing too, when we go back to talking about like that big national phone number or website that you would go to, and then where each day your file gets moved from a system to a system to a system. Working with someone local like yourself, though, you pick up the phone, your underwriter. You have a direct line to your underwriter, Correct. Your processors, the people you work with on a regular basis. You all know each other. You're all able to, it's not like just somebody in a big call center somewhere pushing a piece of paper.
And at those big call centers, there's hundreds, if not thousands, probably hundreds of underwriters. So the way that we do things here at Planet is I have my same 3 or 4 underwriters on every single file. I know them quite well. I know them on a first name basis. I know how they think. They know how I think. So we have that relationship. We call it a pod arrangement, where all my files go through that process. The other thing you touched on, the assembly line piece, it does not work in lending. There's too many lenders who are trying to do everything on that assembly line, where it goes from this person to this person to this person. And the first person you talk to is just gone. You'll never get a hold of them again. I believe that there needs to be one person, that loan officer, involved from start to finish. I'm the first guy you talk to on the phone. I'm the guy that you go to the website to apply through my website. I'm the guy that walks you all the way through it and talks with you the whole way and puts it together. And you will see me at your closing, most likely, closing that loan with you. It's crucial that the same mind is in it from start to finish, because just jumping into the middle of a file is very difficult for any one particular person. There's not one size fits all box. Everybody's different.
All right. So another question I have for you is the fastest you've gone from under contract to close.
Now, this company here, Planned Home Lending, is the best mortgage company I've ever worked for. I've worked for quite a few in 28 years. And one of the main reasons is their speed. I've never worked with a company that's this fast. Normally in lending, 30 to 45 days, sometimes longer. Us, the fastest, 7 days. Just did one in 7 days.
Wow.
We've got a branch here at Planet. It's actually in Colorado that they have a guaranteed 14-day close. Every loan they do, 14 days. Because Planet understands speed is everything in this market. Being able to tell that seller, look, we can perform, and we can perform fast, so you know that we're legitimate, matters. So they have overstaffed in almost every position, and their speed is incredible. Where generally speaking, the places I've worked, if you turn a file into underwriting, the underwriter will get to it in 2 or 3 days. Yesterday, one of my loan officers, Dennis, came to me and said 1 hour. Turn it into underwriting, hour later, here's your full underwritten approval. I'm like, wow.
That's
And
nice
most of the time
turnaround.
it's same day, but 1 hour is the fastest I've seen so far.
And that's a nice turnaround. And obviously you have no control over how long something takes sometimes. So we're not going to talk about the longest one. Although, do you guys work with the short sale process at all?
Oh, I think you have to. That process is, of course, a bit different. And each lender that's on the other side of that short sale, because there's a lender that's selling the loan short that they have, the process is a little different. So we just ask, okay, what is your process? What paperwork do you need in what time frame? And we can go as fast as they want.
Okay.
Sometimes they want to move fast. Sometimes it's a little slower. It's really more dependent on them.
Well, I've just gone through one of these with a client of mine, and we gave 90 days originally from contract acceptance to when we wanted to close, and we wound up going to 120 days. So that was
The worst
pretty
I'd
good.
ever seen, now this was years ago, the worst I'd ever seen was 18 months.
Oh,
Took them, and they hung with it for 18 months. I couldn't believe it.
There was one on the multiple listing service that was a short sale that shows up still pending 4 years.
Okay, I haven't seen 4 yet.
So, and I even called the agent and said, is this a mistake? And she said, no, unfortunately, every time we get towards the closing table, the loan gets packaged in and gets sold to another mortgage company, and we have to start the process over. And it's been doing that for almost 4 years.
That's a shame.
So, because we know that happens too. You guys don't keep every loan in-house. They actually get packaged in and sold, or do you actually keep some of these in-house after the fact and service them?
Many companies talk about they do their own servicing. Many companies talk about they hold most, if not all. This is the first company I've ever seen that keeps all of their in-house loans. Now, they'll broker a few weird exotic products, but if it's internal, we keep 100% of our loans.
So
they sell nothing.
I close my house. I have you as my loan originator, some one of your great people that works here. I write the check every month into Planned Home Lending.
Correct.
Because I've had experience with other companies where you refinance your loan, and next thing you know, you're sold to a large bank, or you're sold to somebody you never even heard of before.
Yeah, these guys actually started as a loan servicer and then the retail, which is my end, later. So their passion is servicing. They want to be able to help that client through the years and retain that client through the years. So it's a little different dynamic than most, because loans are a saleable entity on the secondary market. You sell the loan, you get a little bit of cash. Well, we would rather get the cash over time through the interest paid. Thus, we just retain the servicing.
Which makes sense. All right. That's all the questions I have. Is there anything else you'd want to add about our great market or your services here, or some of the other things you do besides just traditional loans?
Sure. Yes, we do the traditional loans, as we talked about, but we do them better. One thing that I love about Planned Home Lending is we don't have what's called overlays. An overlay is a rule on top of the normal rule that HUD would have, FHA would have, VA, conventional loans. And mortgage companies do that for a varied number of reasons, and they're valid reasons. Sometimes it's protecting themselves, sometimes it's protecting their stockholders, etc. But because we do hold all our loans, we don't have overlays. What that means is if you are to go to another lender, the likelihood of us saying yes over them is higher every single time. It's just how we lend. And it's one of the most exciting things about this company is their aggressiveness in holding their own loans because that is their passion. They're very passionate about that.
So when they qualify somebody for a loan, they're like, we have skin in the game. We're staying with you on this. So we believe in you.
Correct.
We're giving you the loan. When we're going to be here with you for that 30 years if you choose,
right.
or 15 or 5.
And if hard times hit, we're there to work through them with you and give you the different programs available for you.
Do you have programs for people like that? As we're talking, I'm like, because I remember I was a union carpenter in another lifetime, and I was with a large national bank, and that was my first mortgage was through that bank, because that's what I banked with, and that's what we did. And because I was a union member, when I hit a rough patch of unemployment, they had a program for union members where they did deferred payments, or they would roll it into the back end or something like that, so you wouldn't lose your house. Back in 2009, 2010, the HARP program came out with the government. They were doing refinances to help people lower interest rates, keeping their home. What happens if I wind up losing my job? I'm downsized. I have a mortgage with you. You don't go right to foreclosure, right?
No. Well, basically that space changes a lot.
Okay.
You mentioned the HARP program. Right. Well, it no longer exists. It was here for a time. It had an end date.
And it was a helpful program. It helped our family.
There are certain things that are always in play, like the loan modification. When you can't make payments, you have to go through a process of showing what's going on. We just went through, COVID modifications, where if COVID had affected you in any way when it comes to making your payment, you would just have to call us or any lender and say, look, COVID's an issue, and you were able to get what's called a COVID forbearance. And you had options there to defer payments for up to, I want to say it was at least a year, perhaps even longer. You're not seeing that as much now with, the change of COVID, and hopefully it stays that way. But whatever program is out there and possible, we're doing it. And modification is always going to be there. If you have issue, we want to work with you. What people don't understand is when a lender forecloses, they lose. It's rare that lender actually makes themselves whole again. So they don't want that. They want to make sure that you are protected as much as possible. Figure out a way to make this work for all concerned. So foreclosure is the very last option. And we're very much in favor of helping people stay in their home, no matter whatever we can do.
You said earlier you do loans for single family up to 4-unit buildings.
Correct.
So if I wanted to buy a duplex or a 4-unit apartment building, because anything over 5 units is considered a commercial transaction.
Correct.
But a 4-unit, is it much different if I'm going to buy a 4-unit, live in one, rent out 3, than if I was buying a house then? Or is there more benefits in that?
It's actually a lot of benefits. I think that's one of the smartest things you can do.
I know I have a lot of younger clients, that are looking at the house hack, and that's one of their things. They're always looking to find a 2, 3, or 4-unit, live in one, and have the other ones pay the mortgage. But does that help with their qualification too, the potential rent?
Completely. I mean, I wish I was that smart when I was younger to do that, but you can buy a 4-unit, live in one of the units, and you have to sign paperwork, say, hey, I'm going to stay here at least a year. After that, whatever happens, happens. And you can buy it with an FHA loan, minimum 3.5% down. Almost nothing, really, when you look at it. So, and for qualification purposes, you can use the income or part of the income by percentage that you calculate out. The other 3 units you're not in. So you, and a 4-unit, when you do the math, you're almost always, and you can't say always, but you're actually going to make money over and above what your actual payment is. So you're actually buying a moneymaker to live in. Think how smart that is. So yes, it definitely helps with qualification. If somebody only qualified, for instance, for $100,000 loan FHA, they might qualify for up to 200 in a 4-unit because of that extra income coming in.
And be able to get a very nice building in a desirable area where they get higher
Correct.
rents.
That, once they're there for at least a year, decide, you know what, I think I want to live in my own single family because I can rent the unit I'm in now for enough to possibly, subsidize the rest of that payment and then some. So now I just have something creating cash flow. So I think that is an excellent way to do it. So I find a lot of younger people looking at that 3 or 4 unit or duplex that stay there for a time. And then once it's that time of life, then maybe the family increases, or maybe they just decide it's time to live in single family dwelling, but they go on to that. So it is an excellent way. One of the smartest ways to run your life, I think, out there.
Now, you do new construction or renovation loans as well?
Both.
Okay. And what's the difference? Like, what do I need to do a rent? I'm looking at a house, it's beat up, it needs work. I have enough money to buy the house, but not enough money to fix it.
Sure.
How do we do that? What do we need to do to get something like that going?
Well, there's different programs, so the rules are going to vary somewhat. Conventional financing has a program, FHA has a program, VA has a program. A veteran can buy a home and do rehab up to $50K now at a zero money down VA loan.
Wow.
So that's pretty incredible. So, generally speaking, you have to have an idea of what you're going to do. But with all of these, general path is you've got to have in writing an actual, hey, here's what I'm going to do with costs. Generally speaking, some sort of a general contractor taking care of it. And then all broken down. Now, the contractors will be vetted by us to make sure they know what they're doing.
Right.
They've got a reputation. Their licensing is as current as it can be. So I always tell folks that it's almost like 2 parts of a loan. You've got your regular qualification you go through as a buyer, but then we also have to approve the project itself. So we're approving, the roof, the new driveway, the whatever the heck you're doing as well through the proper contractors who can do it. And then we make sure at the end, meaning after appraised value, fits within the guidelines. And those guidelines are, okay, I'm putting 50 grand of work into it, and the place is now worth, 60, 70 more. Sure.
Okay.
Of course, that makes sense.
They're not going to put 50 grand into it to gain 20,000 in value, though.
Well, number one, you wouldn't do that. Number two, we would be under collateralized and most likely not want that either.
Right.
But believe it or not, with an FHA 2 or 3K, you can go to 110% of after approved value. So that one you can be slightly upside down on and still qualify.
And in today's market, with the values changing as rapidly as they are,
that 10% is gone very fast.
Very fast. All right.
Under a year right now.
And then I buy a beautiful lot, like one I have recently for sale at Lake Somerset, and I want to build a house on it. You guys do that process then and work?
Yes, we have
Basically,
products for construction draws, or once again, you got to have a general contractor. The one thing you can't do, at least at this time, is be your own general.
Right.
You can't be the builder. Somebody else has to be the builder. I've had actually builders come to me and say, I want to build my own house. And no, you cannot build your own house. You can hire your friend to build your own house, but you cannot be the one that builds your house.
On paper, with the loan, they have.
I didn't hear that, but yes.
So if you want to learn how to get around that system,
talk to a contractor from the past.
Talk to a contractor, talk to a realtor, talk to people, talk to a professional always to find out what you can and can't do. Because I found that out recently too, that if I wanted to do a certain build, I'd have to either come up with the money myself or hire someone to be my GC, even though I had 20 years experience in being a GC.
Right.
So I get it.
It's kind of funny, but it is what it is. And the idea,
I'm not licensed to do it, and they don't
Right.
just hand you money, then you disappear.
well, think about how many people who have no idea what they're doing get in over their heads and destroy their house and the money they have invested. It's those situations or why lenders just say, nope, no one allowed. We're just not going to let it happen because you harm yourself. And lenders try to protect as much as humanly possible the borrower in any case.
Unreal. All right. Bruce, people watching today, they're thinking of making the plunge. Maybe they have a loan right now and they're like, I want to refinance. I want to pull some equity out. I want to do this. How do they get a hold of you and your awesome people here at Planet Home Lending?
Well, there's a couple of ways, but probably the easiest is going to be just give me a call. 815-494-1990. I've had that cell phone number since there has been cell phone numbers, and it's the only number I use. I just find it easier than, hey, here's my office, here's my cell. No, one place. I'm available nights and weekends
I know
to the
that.
chagrin of my wife. But hey, she understands. The vacations we take means that, I work when you're looking at homes. Look, this is a big deal. You're out on Saturdays and nights because that's when you're not working, right? So much of the work I do is at that nighttime or the weekends to help people out. Because in this hot market, especially, time matters a lot.
Yes.
You need to be working with someone who's fast because homes are gone in hours many times. So we don't have time to wait for the weekend to end before you get a hold of your lender.
That's the unfortunate reality, and that's why we're recording this so early in the day.
Yeah, because later on I'll be
Later on,
unavailable.
We're both going to be unavailable.
Right. So call my number, 815-494-1990. And I can do one of two things to start the process. I can ask you questions over the phone, or I can text or email you my link to apply. Now, when this technology first came out years ago, I thought most people would want to talk to me over the phone, and I was sadly mistaken. I'm going to say about 99% of people, before I even finish the sentence, say, yeah, text me a link. Just text it to me. That way you can fill it out when you have time. That time, 11 o'clock at night, fill out the app on your phone. Fill it out on your computer. Doesn't matter. And also with our technology, you have the option of uploading all your documents. And if you're not that type of person, okay, you can drop them off in my office, or I can pick them up at another location. We are as flexible as possible. But since speed matters, remember, we talked about that full pre-approval is what you want. I am going to need to see those documents as soon as possible to give you a good, solid pre-approval for you to buy a house. So yeah, it is very important to have your W-2s, your pay stubs, your assets together, things of that nature.
Which you should have your files all in order, get it together. If there's something you're not sure about, it'll be in the checklist.
Sure.
I've went through your technology. We have mutual clients that we're both working with. And what I love about it is, as the realtor working with that same client, I get filled in on what step of the process. I don't necessarily know what you make or what you're qualified or whatever that is, but I get filled in that we've been approved. We've been to this part. We're in process.
Appraisal's back in. You're clear to close.
And that technology just helps keep us in the loop, so I know what steps I need to be at for my job. So working with a company like yours that has those checkpoints in place and not only tells the person lending the money, but also the people working on the transaction where we stand at all times, that's very appreciative.
Well, and one of the things I mentioned about technologies, I remember vividly 20, 25 years ago, where it was widely known in mortgage circles that we would be replaced by a computer and that people would not need loan officers anymore. People would not need underwriters anymore, that it was going to be all automated. But what happened is what I thought would happen. A computer cannot do what I do. Human nature. You add human nature to the equation, and every situation is different. People don't know that they can't do a Zelle payment for $1,000 from a buddy, and that's going to qualify as money that they can use to buy a house. People don't, understand the rules, if you will. So that computer program is a great help. It's an incredible documentation, but you've got to add that human mind to the process to make it go and make it work. So yes, we use technology, but we're not just technology based. It's just an augmentation of what we do.
All right. Well, that's great, Bruce. I want to thank you for your time today. Remember, everybody, to reach out to Bruce. Is at Planet Home Lending, and it's 815-494-1990. I know the number by heart. I use it all the time. So that's how you reach out to get a hold of Bruce. And then I want to remind everybody too, at the bottom of this here, there's a subscribe tab. This is only episode 2 of season 1 of my Selling the Stateline vlog. And if you like the content, please give us a thumbs up and hit that subscribe button. And always, you could find more information about the houses that are available on the market, meet up with people like Bruce, or even just get a valuation of your home by going to buywithbroda.com. And I want to thank you for watching. Leave us a comment. If there's something you want to know more about this industry, you have questions for Bruce, put them in the chat box at the bottom, and I'll make sure he gets them and reaches back out to you. All right, everybody, thank you very much for watching. Bruce, thank you again for your time
My
today.
pleasure. My pleasure.
Congratulations again on the new office space. We
Thank you.
did the ribbon cutting this morning with the Stateline Chamber of Commerce, and it was a great turnout. I mean, you had probably like 60 people in here this morning.
Yeah, it was a really good turnout. We had a good time. We had food. We asked a lot of questions, got to do some networking.
Yeah.
You know, it's what we're here to do.
And there were some great people. And our next vlog, I've already got our guest set up. It was somebody that was here today. It'll be we're still sticking on that house theme. And don't forget to look back at last week's episode at George Puskavich. He's actually a loan originator from this company as well, a good friend of mine.
Yes, he is.
He just came back from Poland. So watch episode 1 and you'll get to hear about his adventure visiting his family in Poland. They're refugees right now from Ukraine, and where hearts go out to Ukraine. We stand with Ukraine at my vlog anyway. And thank you very much again for watching. Have a great day, everybody.
Take care, guys.